from an accounting standpoint and from a reporting standpoint, they have the ability, banks have the ability to group their holdings, treasuries and mortgages, into two buckets. One is held to maturity, which does not get marked to market from an accounting perspective. And the other is available for sale, which always gets marked to market, essentially every day or every time they report. So banks have a lot of leeway on how they classify those. Now they can't really throw them back and forth in between those two categories, but there's a lot of leeway to what they actually report, and a lot of leeway in terms of what actually makes it through the financial statements. And unfortunately, it sounds like they also used these accounting conventions to help them manage risk, which is kind of mind-boggling. So this is truly significantly different from the 2008, 2009 stuff. So let's look at this first chart. And these two charts together will start to give you some background on not only Silicon Valley Bank, but also what's going on at a ton of other banks. And so if you take a look at this chart, what it basically shows is that over time, principally around COVID kinds of things, right? When the Fed was pumping money into the system, the federal government was pumping money into the system, there was all this cash running around, right? So people had money in their pocket and they deposited them in banks. But what all that work didn't do was stimulate increasing loan demand. So what this chart shows, principally after the 2020 recession, right, COVID, which is that big gray bar in 2020, what this shows is that banks built up cash, built up deposits on their balance sheet in excess of the loans that they were able to make or wanted to make, or the demand for loans exhibited. So they had all this excess cash. So they had to do something with that excess cash. And bank after bank after bank, whether you're talking about the community bank on the corner probably, all the way up to JP Morgan Chase, took those excess deposits, that excess cash, and basically bought treasuries and mortgage-backed securities, right? And there are limits on what they can buy and how they need to do it. But at the end of the day, they took all that excess cash, all that cash that they had sitting from deposits that they didn't have loan demand for, and boom, they bought treasuries and mortgage-backed securities. So everybody understand that this chart where you start to see deposits going up much faster than loans, which is why from 2020 to sort of the bottom here at 2022, you see this measure of liquidity, loans divided by deposits, actually going down. That chart makes sense? We're good?
It's an awesome chart. It makes a ton of sense. And it's great just to go through as you are. Are there different measures of the banks to see how they're going relative to one another?
Yeah,
as far as,
sorry.
Go ahead, please.
Yeah, I mean, that's why I put that little, you can't look at this in isolation. There are more measures of bank liquidity than the day is long. And the Fed and the regulators have a series of liquidity measures that they're constantly evaluating, constantly monitoring. The whole capital requirements has a whole series of kind of liquidity measures and other measures of the bank's ability to raise funds, as well as the top 10 or 15 banks, right? Those that are systematically important to the economy and to the world. They go through a rather significant stress test. I can't remember, it's every quarter, twice a year. So there's all these measures out there of liquidity, depending on exactly what the purpose is. But this is one of, a laundry list of liquidity measures that I thought was just kind of easier to digest than starting to take a look at liquid, the bank's ability to raise cash versus their cash needs over the next 30 days and all that kind of stuff. So this one made the most sense to me for ease of explanation, and it really helped me understand what was going on and where they got all this cash from. So if we go to the second chart, right? So these banks have all this excess cash, right? What they start doing with it? Well, they started buying federal debt. They started buying treasuries and mortgage-backed securities. And when did they buy a lot of these, right? They bought them before the Fed started hiking rates, right? So they bought it when the 10-year was less than 1%, right? They bought mortgages when mortgages were between 2 and 3%. So, I jokingly said this the other day, but they're buying high and sort of selling low here, right? So they bought when interest rates were at their lowest point, which means all these securities had their highest value. And then all of a sudden, sorry, go ahead.
And I noticed SIVB bought and speculated.
Well, I don't know if it was, they have very limited ability to do things speculatively, right? We'll talk about, yes, we'll talk about hedging in a minute.
Okay.
Yes, absolutely. So all these banks, again, from JP Morgan Chase all the way down to the probably bank on the local corner, were buying securities that they were allowed to buy. In fact, the latest rules and regulations probably encouraged them to buy essentially treasuries and mortgage-backed securities at the high, right? When interest rates were the lowest. Now, Jonathan, to your point, some very smart banks like the JP Morgan Chases of the world hedge that interest rate risk, right? So if the market, if interest rates did increase dramatically, which they did, they had a hedge on to help manage the interest rate risk, right? To manage that mismatch between buying a 10-year bond and having a deposit that could leave at the drop of a hat.
Yeah, they're trading the yield curve. They should be hedging themselves across the yield curve.
Correct. And I think but I think some people may have done it knowingly. I think other people, it was just, especially the smaller the bank, it's beyond their level of sophistication. And this whole held to maturity accounting comes into play because it was very easy for them to say, hey, I've got $1 billion in extra cash. Let me buy $500 million worth of securities and call those available for sale and mark them to market. And let me buy another 500 million, call them held to maturity. I never have to mark them to market. And I can just let them eventually mature 10 years down the line, collect the interest, collect the principal. I don't have any loss.
That's great in a video game, I guess.
Yeah, but right, and all that works until somebody starts draining deposits, taking deposits out, and all of a sudden you need to raise cash, and all of a sudden all those held to maturity securities are in play because you need cash, they're not hedged, and you're sort of getting punched in the face through losses.
Right, they're worth a tenth of what you paid for them. Sure, you can hold them for 30 years, but you're not going to be able to finance it.
Right. And so if you, let's just say you bought a 10-year on, January 1, 2020, right? The 10-year treasury rate was probably less than 100 basis points, probably less than 1%. As of last week, right, that was close to 4%. That represents somewhere around a 20% loss in value. That's not insignificant for any financial institution. And then it's further complicated by the fact that some of these are mortgages, right? So they're pools of mortgages, right? And if you think about a pool of mortgage, they have my mortgage, your mortgage, hundreds of other people's mortgages. You really don't know the maturity of that mortgage bond because I may move, I may sell my house, I may move into an apartment, I may live in this house until the cows come home, rates may go down, I may be able to refinance. So nobody knows the maturity of any particular mortgage-backed security. Sure, there's estimates, there's models and all that other stuff, but you really don't know what that maturity is. And so when you buy the mortgage, right, you buy the mortgage-backed security when rates are at 2 or 3%, and you have a model that basically says, hey, if rates stay around here, chances are on average, these are going to pay off in 6 years. So you treat it like a 6 or 7 year treasury from a thought perspective or from a hedging perspective, if you're smart enough to do that. But then as interest rates go up, I'm less likely to sell my house, right? Because it's going to be harder. I don't want to sell it at a lower price. I'm certainly not going to refinance. And so all of a sudden, the average maturity of all those mortgages gets extended. So not only do rates go up, but a mortgage-backed security that you thought had an average maturity of somewhere around 6 or 7 years, all of a sudden has a maturity of 10 or 12 years. And so you get a double whammy. You get one whammy from interest rates going up and the value of the mortgage is going down. And then you get another whammy because the duration of the mortgages have increased. Becomes a longer term debt instrument than when you originally bought it.
But it seems like all these banks are sitting on large mark-to-market losses. Are they required when, and this is a CFA question, I guess, but when they're releasing quarterly earnings, are they marking the fixed income to market?
So here's what happens, and I'm 99% sure I still got this right. So for those instruments, those bond instruments, those debt instruments, the treasuries and mortgage-backed securities that they're labeling as available for sale,
Yep.
those are marked to market and the hedges are marked to market. For those mortgages or treasuries that they've classified as held to maturity, they don't
Yep.
mark those to market.
That's such bull.
They are held at cost, and basically from an accounting standpoint, the same way you'd accrue a bond. So if you paid 101
Yep.
for a $100 bond, what would happen is you would recognize the interest, right?
Yep.
And you would recognize some amortization of that premium. But if you paid 101 and it was worth 90, that doesn't flow through the income statement.
Right.
And
They just look at it as invest.
I'm holding this forever. I'm never going to need to touch it.
And that was a big case for in this situation where they had to market and they just didn't have any money behind it.
That's the whole ball of wax.
Unbelievable.
That's exactly what happened. As well as in this particular case, right? They didn't have a risk manager for 6 or 8 months, all that kind of stuff.
It's amazing when you look under the hood though for some of these, and we talk about JP Morgan hedging and even banks like this with, systemic risk. Real systemic risk to everybody not having any kind of protection against something like this.
Yeah, it's crazy. It's crazy. Hey, John, I'm not sure that that's completely correct from an accounting standpoint. So if it's a held to maturity bond and you pay 102 for it or you pay 98 for it, you start out with the value on your books at 102 or 98. The only way that starts out as par is if you only pay par, unless the accounting rules have changed rather recently, but I don't think they have. That's the way bonds have been accounted for, since I was in school 150 years ago. So unless I'm missing something.
I really just want to reiterate, guys, how much risk is in the market right now. And when things like this, and so when we talk about moves in the market, there's a significant reason on why there's going to be this increase of volatility. Is going to stay for a little bit until all this is figured out. Usually, not usually, every time, this doesn't happen in isolation. There's others that will fall. And you see it a little bit in the market, and you see it with volatility increasing. But this is why we always want to stay hedged. And also, just it's okay to trade a little bit less, trade a little bit smaller size, knowing that we're going to have more volatility.
Right.
A question for Mike: if a bank has a stress test pending, do they manicure the books just to pass the test? Hope not.
So there is absolutely, positively window dressing kinds of things that go on. And so it wouldn't surprise me is if you watch Twitter or some other places, you'll see some people make comments that particular moves in equities or in particular bonds are because banks are sort of truing things up for quarter end for their balance sheets and for the upcoming stress test. Absolutely, particularly for liquidity ratios. And you'll see that also for large fund managers, right? At the end of the year or the end of a quarter or an end of a month when they have to report, if Apple went up 10% and they don't have any Apple in their portfolio and they miss the run up, you see these guys actually buy a little Apple at the end of the quarter, at the end of the reporting period to show that they were holding Apple. So somebody doesn't ask them, how come you don't have any Apple? So yeah, Nancy, mark to market is what the bond is currently trading for. So if I buy a bond at 98 and the mark to market, or what you see in Toss or your platform says 92, I just lost essentially 6 points on that bond, and that's the way I'll carry it on my balance sheet. And if you think about it, right, these banks have these huge trading floors, right, size of football fields plus. Everybody's got a position. They are marking all those positions. I was going to say every single day at the close of business they do, but they're marking them throughout the day. So it's a very common set of procedures and processes that banks have. The challenge is when you start buying illiquid stuff that it's hard to get a mark on, and that's part of the issue with Silicon Valley Bank, is because you see all these losses in securities that you can value, right? You can call up a trading desk and give them a Ginnie Mae certificate number, and they'll come up with a quote. You say, hey, I'm holding the March, whatever it is, 10-year for 2027. They'll give you a quote. The other complicating factor here is that they had a loan book, and who knows where those loans are really valued, who knew the credit quality, and who still knows the credit quality of those loans. So my guess is, right, whether it's the Fed or the FDIC who's ever managing this, has got that loan book out for quotes all over the street. And part of the challenge here is it was kind of apparent that no bank was willing to step up to the plate here and essentially buy Silicon Valley Bank. Now, that may have been because it was too quick. It may have been because they couldn't get comfortable for the loan portfolio. It could have been because the Fed and the Treasury and the administration said, hey, we're not backstopping and providing any funds like we did in 2008, 2009. Who knows? But I think the other shoe to drop here is what's the quality and what's the realized value of either Signature Bank's or Silicon Valley Bank's loan portfolio, on top of the fact that Silicon Valley Bank would syndicate loans. So they would originate, let's just say for argument's sake, a $500 million loan. They would keep 250 for their own books and sell the other 250 to other banks. So other banks may have some of this loan portfolio on their books at an uncertain value that nobody knows about. So that could be another shoe to drop here. Does that make Jonathan? Does that make sense? Am I confusing anybody? So let's talk for a minute about the difference between what's going on now and what happened in 2008, 2009. Two things were really going on in 2008, 2009. One was just an unbelievable amount of leverage by people like Bear Stearns, even JP Morgan Chase, all the banks across the board, right? Rather than having $1 of capital, let's do this a different way. Rather than having $10 of capital for every $100 in assets, which is pretty much what they're required to do today, right? They had $10 in capital for $200 worth of assets. So they were levered 20 to 1, 30 to 1, maybe even higher than that. So they had very little margin for error. They had very little capital standing behind their asset base. So if something did go south, they didn't have a shock absorber. That's what capital is. They didn't have that shock absorber in place. And you take somebody like Bear Stearns, who probably leveraged at 30 to 1, maybe higher, and we're holding all these risky mortgages. It didn't take much for them to turn around and say, holy cow, all our capital's gone, right? You make a lot of money with leverage when things go your way, right? Stuff hits the fan really, really quickly when it doesn't. So because of all the change in bank regulations, leverage is really not as much of an issue here, right? The other thing that's not as much of an issue yet is credit quality, right? A lot of what drove what happened in 2008, 2009 was credit issues, right? The mortgages backing all these mortgage-backed securities, or mortgage-backed securities on mortgage-backed securities on mortgage-backed securities, was crap, right? It was loans made to folks under circumstances where either they didn't intend to pay, they couldn't pay. It was just kind of like the Wild West. And so you had two things going on that aren't going on now yet, right? You have this leverage issue and you have the credit quality issue. And that's why I think the Fed, the Treasury, and the administration were pretty comfortable by saying, hey, let's guarantee all the deposits. It sounds like we're guaranteeing them forever now. Let's go ahead and do that, because this is really a valuation and hedging and duration problem, not a leverage and credit quality problem. The other challenge here is that some of this is out of a bank's control now. So I could be a bank, I could be a regional bank, wherever, a small community bank. I could have held my securities, I could have hedged them, I could be in perfect shape. But if there's a run on my bank, right, people take deposits out of my bank to go put it in JP Morgan Chase, at the end of the day, there's not a lot I can do to stop that, unless, which is going to happen, I actually start paying interest on deposits to keep them from escaping. Yeah, Dave, it's really hard to tell. My guess is if there was somebody else who was really, really in big trouble, they would have closed them over the weekend, right? It's hard to close something on a Tuesday because you just don't have enough time to sort of get your act together to be open on Wednesday. But you can just see, right? First Republic, I don't think it's traded in the last hour plus. My guess is that's probably DOA, and there's probably a couple other ones. The one that we talked a little bit about on Friday in Discord, PACW's been bouncing back and forth. I think that's been halted mostly because of volatility. They actually tried to fix some of this stuff in the fourth quarter, and actually did a pretty good job of it. But no matter how good a job they did, if people want to take their deposits out, they're in trouble. I think the interesting thing about PACW is I looked right before we got on here. I think a couple folks actually rated them a buy today and upgraded them an overweight purchase, an overweight portfolio allocation. So who knows?
I think there's going to be some phenomenal bottom fishing down here because they're going to hit the entire sector, and some of them are going to be okay.
Tremendous amount.
I'm looking at Fifth Third is always a bank that I really like as well, Midwest Bank in Chicago.
Yeah, they're great. Huntington should be fine. All that. There's a whole bunch of those guys that should be fine. Although, and we can talk about this another time, their economics will change.
They have
right. The regional and local community bank economics are going to look completely different even after all this is resolved for a variety of purposes. And part of what's going to go on here is folks are suddenly wake up to the fact that if I'm a company and I've got $1 million in bank XYZ, I got to sort of pay attention to what's going on with bank XYZ. Or even if my deposits are guaranteed, if it takes them a week to sort out all the banks and stuff, maybe I'm short payroll for a week until I can get access to my cash.